Hey, welcome to Retire Mentorship live on YouTube, and we're going to be here every week on YouTube. So my name is Freeman Lindy. I'm a certified financial planner and enrolled agent that's a licensed tax expert, and I work with folks, particularly those folks over 55, getting close to retirement, and we run this channel, right? I'm author, I've written a few books, and we are now doing a new format for the show, and we're focusing more on the YouTube side, more on the visuals. And so we're going to be here live on YouTube every week at 4 p.m. Central Time on Wednesdays. The video will post right afterwards on YouTube, so if you can't make it live, feel free to come back and check it around. It'll also be sent out to Spotify, Apple Podcasts, and you can either watch or listen to it on those platforms as well, just like you could in the past. And so we've always had that, but now we're gonna have this option to join us live, which will be fun because we can do some Q&A, we can do some chat, we can put comments in there. And so we would love if you were able to join us live. Drop your comments in the chat below or to the right or left or wherever it is on your player, and we can do that. I think we're also streaming on Facebook, so you could always see us there, but YouTube is gonna be the main platform to join us. And so each week, what we're going to do is we're going to have a main topic that we're going to talk about. That's going to be the subject of the video. So if you're interested in seeing that, we should have the preview posted each week, and so you can see what we're going to be talking about at the upcoming one. Maybe you set an alarm for it because it's something you really want to join in live for, or maybe you just set a reminder to go check it out later. Either way, you want to subscribe to the channel so you can see those right in your feeds as soon as they are going live. And of course, if you hit that notification button, you also get notified when you get those. So I think it's gonna be awesome. So right, the main topic, Q&A in the YouTube chat. If you can't make it, you can always, you can post questions in the chat and we'll answer them live on the show. And if you can't make it live, you can always send us questions to questions@retirementorship.com, and we'll feed through those and grab some each week to answer kind of in shorter form on that. We'll also introduce some other segments along as we go, and so it's going to kind of become this whole show that we do each week instead of just a monologue. So should be fun, really looking forward to it. We've got my producer, the one and only Ethan Kessler, who's going to be running the show in the background, and so we're going to have some fun with it too, because I think finances should be fun. So for today, right, we got our topic today, saving taxes in 2026. Tax season is upon us. We're all thinking about it all the time. We're getting all the commercials for TurboTax as we're trying to watch football, right? We're right back into that season. And so as most of us are thinking of our 2025 taxes, it's also important to think about our 2026 taxes. So that's what we want to talk about today in our main topic. But before we get there, we do have a big announcement for the public for the first time. If I can get a drum roll, please, Mr. Kessler. I don't know if that's going to work. Oh, there you go. Look at that. So we have my new book. There we go. Tax saving strategies. It's coming out this spring. There's a link in the description where you can check out more. We'll talk more about it later on in the video, but it is all about how do you save on taxes. There's way too many strategies that you need to do in advance. You need to know them ahead of time. You need to plan for them. You need to know when you can and how you can do those. And if you wait until tax season to look last year, you're going to miss out on a bunch of them. So if you want to save taxes for 2026 and any other future year, you're going to want to know these things. And so it's been about 4 years since I released my first book, 3D Retirement Income, which you can get for free if you're a Retire member, or you can get on Amazon if you don't want to give us your email address. And so that's been a big hit for a lot of people. And so now we figured, hey, we looked at the retirement income, kind of investment side of it. Now let's look at the tax side of it, kind of the two most important parts of retirement. And so we're really excited for this. It's coming out again kind of in March. So we're looking forward to getting that in your hands, and we'll talk more about it in the end. But first, let's talk about how do we save taxes in 2026? What's kind of some of the big things that we can do? And the way that I like thinking about that, and some of this is covered in the book, so we're going to kind of give you a preview of what's in the book as well. But the way that I like to think about it is on a tax continuum, right? And so if we say, hey, we've got lines, a continuum one way or another. The first part of that continuum is what most people think of when they think of taxes, and that is last year's taxes, right? They're looking at last year and they're saying, hey, it's tax season, it's in the spring here, right? So we're going to be looking at 2025 taxes. Do we have all of our credits, all of our deductions, all of our ducks in the row? Our documents are all coming in. And so we're always looking at last year, right? And the way to think about that then, right, is we're really looking at, we're looking in the rear view mirror, right? It's a little mirror, highway, and we're looking backwards and we're saying, hey, what did we do last year, right? How do we make sure we pay the least amount of taxes last year? Anything else that we're missing to just rectify the history of that, right? But that's just history. There's not too much we can do about it. And so way too many people have all their focus looking in the rearview mirror at what happened before. We want to widen your horizon, right? And look forward way more than we want to look backwards. And so the next part of that continuum then is not just last year's taxes, but lifetime taxes, right? What are we going to do in the future? And so, I, I'm no artist. My wife was the art teacher, but if that's a windshield, and now we got our little, our little rear view mirror at the top there, right? We want to spend way more time looking through the large windshield than we want to spend looking through the tiny rear view mirror, right? And as we're looking through the windshield, right, we got to say, hey, here's the road out in front of us. But we also want to know, hey, is there any off ramps that we should be taking? Are there any crossroads that are coming up in our tax future that we need to know about? And frankly, for me, right, I'm way more concerned that you pay the least amount of taxes total over your lifetime than I am about paying the least amount of taxes last year. Right? We'll often say, we'll pay the IRS every dime we owe them, but let's not leave them a tip. Right? And so the way to do that is this is really the ratio that you should have. Tiny bit of time looking at last year, most of your attention focused in the future. But so few of us do this, right? Because last year, filing taxes, all that, that's what's required. We have to do this part. We don't have to look forward. And we're really bad as Americans is only doing the things we need to do and not necessarily the things that we should do. And so that's part of our job, part of this channel's job, right? Is how do we help you look forward and look at your lifetime taxes? But there's one last stage in that continuum. So we got last year taxes, lifetime taxes, and then if we could, and again, bear with my terrible drawings here, but something like bloop, bloop, get some binoculars. We'll say those look like binoculars, and we want to look way far forward, farther than we just look out the windshield. And so last year you got lifetime, and last year you got legacy taxes, right? What did we pay last year? What am I personally, what are you personally going to pay over your lifetime and over the lifetime of you and your spouse if you're married? And then what is the next generation going to pay? Right? What are your kids going to pay in tax? What are your grandkids? And not on their money, on their income, all that. That's their problem, right? But most of us are planning to leave something to our kids, right? There's some people who are trying to slide into home plate with $0 in the bank, right? Hey, we don't want to leave, we're spending our children's inheritance. We don't want to leave a dime to them. We're hoping that last check to the undertaker bounces on our way out. And so there's some people that take that approach, and that's fine. But for a lot of us, we're trying to leave something to our kids, something to the next generation. And what kind of taxes are they going to pay on that? Because what a lot of people don't realize is that even though in their attempt to minimize taxes last year, they are not only screwing themselves over down the road, but they are going to end up settling a huge tax burden on their kids, and all the money they think they've saved, ultimately half of it's going to the IRS because they didn't do proper planning, right? And so the way that this breaks down then is this part, of course, is tax prep, and this is tax planning. I don't know why that one's capital. Planning, there we go. And so that's the kind of the two main parts. And so again, this time of year, we're doing tax prep for last year. That's fine. We also want to make sure we're looking forward and looking at lifetime and legacy taxes, right? So those are your three stages of taxes, and there's ways that we can save taxes on all of them. But before we do that, right, we always want to begin with the end in mind. And so we got to figure out, hey, what is the goal, right? It's got a little arrow and a target there. What is the goal of everything we're trying to achieve with tax planning, with tax prep, all of that? And for a lot of people, they think the goal is to pay the least taxes. That's the goal, right? Isn't that the whole point of this? Like, hey, we want to make sure that we're paying the least amount of taxes last year, the least amount of taxes over our lifetime, and the least amount of taxes in our legacy, right? Wrong. That is not the goal. The goal is to have the most money after paying taxes, right? That's the goal. And people confuse this a lot, right? Because there are a lot of ways that you can pay less taxes, right? So let's take it to an extreme, right? Let's say you really hate paying taxes and you're like, hey, I want to pay the least amount of taxes. Awesome. I got some really easy strategies for you that's going to really reduce your tax bill pretty much to zero. Okay. Number one, quit your job. That way you have no earned income and you'll pay no taxes on it. Number two, sell your house and live under a bridge. That way you'll own no property and you'll pay no property taxes. Number three, you can convert all your investments back into your checking account. That way you'll earn no interest, no capital gains, and you'll pay no taxes on any of that. And number four, you can steal everything you want, so that way you'll pay no sales tax. And there we can just completely eliminate all of your taxes, and you will pay the least amount of taxes of anyone else you know. And that obviously is absurd, right? Because that's not the goal. And sometimes taking it to the extreme helps us understand what the real goal is. And so obviously we're not going to do that, but for a lot of people, since they are focusing, right, they got the wrong focus, they're focusing on paying the least amount of taxes, it will lead them to do strategies that are dumb. Right? That yes, they save in taxes, but part of the reason they save in taxes is because they have less money, right? If we look at it, right, if you've got this amount of income over time or this amount of growth, right, and you owe 20% taxes, yep, or whatever, right, you're going to pay this much in taxes. And obviously, if you have this amount, you're going to pay more in taxes because you had more money, right? And so, but a lot of people say, well, hey, but this is less taxes than that, so let's pursue this strategy because on paper it looks like less taxes. Right. And so they're pursuing the wrong thing. And so this often is like certain products, certain insurance-based products, annuities, life insurance, permanent life insurance, these kind of things. They tout their tax savings benefits, right? Hey, we're going to help you mitigate taxes. Hey, you know it's important to diversify. You've heard about diversifying. And so we're going to help you diversify not only your investment risk by getting some of your money out of the market and into these protected products, we're also going to diversify your tax risk by mitigating taxes in the future because we can access some of this stuff in a tax preferred manner or whatever, right? Whatever the pitch is. And so, and it's true. You do pay less taxes in some of these. Some of it's just because you have less money, though. And if you have less money, you pay less taxes. Some of it is features of it, and you're not necessarily paying less taxes because you have less money. Like the feature of the product actually does help you pay less taxes. But again, the total impact of it is still less overall, right? And so that's what we got to be really careful. And part of planning, right, is part of any financial planning, not just tax planning, is, hey, there are the things you should do, right? Save, invest in Roths, HSAs, bunch of other things that you should do, right? But then there's also things you shouldn't do. Roll balances on a credit card, right? That's dumb. Go to a payday lender. That would be dumb, right? So sometimes planning is just as important of what you don't do and what you avoid as what you do. So part of saving taxes is being aware of the bad strategies that are out there and avoiding those, and then of course knowing the good strategies so that you can actually do those. So how does all this apply to saving taxes in 2026? Well, there's a whole bunch of ways, and so I'll just kind of run through them with some of you. Right? There's Roth ways, there's credits and deductions that you can get, different brokerage strategies, charitable gifting, tax bundling, HSAs, and a ton more. And so there's actually a ton of ways, and it's more than I can say in one video, right? And the big kicker is most of this you need to know in advance. Right? If you're like, but I've got all of 2026 to do that. Okay, yeah, and then you're going to forget, and we're going to be at this time next year. And I'll be doing another tax video in January, and you'll be like, crap, I didn't do any of that stuff last year. Well, now it's too late. Because most of the deductions, credits, strategies that you can do, you need to know them before the year is over. Right? December 31st is a deadline for getting a lot of things done. All right, it's not April 15th. April 15th is when you need to file and when you can do like Roth and HSA contributions for last year. Yes, you can do that. Pretty much everything else, end of the year is the deadline. And so we need to know these things, and not just know them in November. Because sometimes you get to November and you're like, hey, we could have done this, but since we already made this distribution back in April, or this distribution, or we sold this thing back in July, now we can't. Right? And so we need to know what strategies we're eligible for at the beginning of the year. And that's why it's not save taxes in 2025. We're talking about saving taxes in 2026. Right? And so if you want to know how to save taxes in 2026, a couple things that we can do, right? Number one, you can subscribe to this channel. That way you get a bunch, we're going to do a bunch of tax content here in February, in March, etc. And that way you know all this stuff in advance. So subscribe, that way you can get all that stuff. Join us live if you want to be able to comment and all those things. So it's gonna be great. And then you can pre-order the book, which we'll talk about in just a second, right? And that will give you in advance the things that you need to know so that you can save taxes. That's the goal, right? And most importantly, right, have the most money after paying taxes. So we'll talk about the book here a little bit. So, right, we've got tax saving strategies, how couples over 50 can minimize long-term, lifetime, and legacy taxes, right? So again, we're just skipping last year because we just figured, hey, the year's over, and we're really just looking at long-term and lifetime and legacy, right? So a couple of things, right? First of all, it's how couples over 50 can do this. So a couple things about that. If you're single, you could still apply. This could definitely still apply to you. I just didn't want to always be listing single and married filing jointly tax brackets all the time and all the differences, right? And so you can still find them. I'm trying to make the scope really narrow to make it really applicable. Because I've read a bunch of other tax books and they try to be everything to everyone. Right, and so they're talking about business owners, they're talking about retirees, and they're talking about a first-time home buyer's credit and all these other things. And like, man, if you are 55 or 65, right, and you're about to retire, like you don't care about first-time home buyer credits, right? And so I'm not going to get any bestseller awards for making this book as narrow as I am. I'm not trying to get the most people to read it. I'm trying to make it the most impactful for those to whom it applies for. So if you're single, you can definitely still get this, even it's just gonna be written at a married lens, so I'm not constantly having to differentiate between those two, and then you can just back it off to single rates and whatever else for yourself. But again, it is really for people over 50, because again, we're gonna exclude the younger things. We're really looking at retirement, tax saving strategies, things in your final stages of your career, things in those categories. We're not going to be talking about business credits or agriculture credits or all these different things that are in a lot of these other books to really make it specialized just for you. And then again, looking at long-term, lifetime, and legacy parts of the continuum. So again, you can know all these things in advance, and we'll be covering all these different strategies of how to do it. So it should be very practical. I would say 80 to 90% of the book should apply to you if you're in that category, which is pretty helpful. So I want to show you real quick what you get because it's going on sale later. It's going to be available on March 26th of 2026. So there's a link in the description of the video. You can just click that and you can go in and pre-order it. And so this is what you get if you pre-order, right? What you're going to get is you get the book. Should be $20 on Amazon. You'll also get the audiobook version. So we'll be doing the full Audible audiobook version. And so we will send that to you for free afterwards when that's available. We also have a bonus tax workshop. So if you want to get additional, if you like to watch things more than you like to read things, you can get that workshop. That'll get sent out to you. And then you also get both my hardcover book in 3D Retirement Income and the audiobook for that one as well sent to you as well. So all of that, if you had to buy all that separately, retail price, it's about $150, and you're going to get it for free. And the way this is going to work is you will pre-order the book on Amazon, and then we will reimburse you that cost and send you all this stuff. And so I'm not saying, hey, go pre-order my book so I can make money. We're losing money on every book that we do, obviously. And you might be saying, well, why are you doing that? And so I'm gonna be totally straight with you because I feel like there's too much people kind of having weird motives or hidden motives on things, right? I want to find great clients that I can help walk all the way through retirement, right? And anyone who doesn't want to be my client, I still want to help them for free through a bunch of free content. So I can have a massive impact by helping a bunch of people for free, a little bit, and then a few people a ton, right? And so that's my thing. And I think it can be scary to trust your life savings over to someone that you don't know. And so doing YouTube content, doing podcast content helps you get to know me, helps you get to know my philosophies, and helps you decide, is that someone I can see working with? And so what can happen, right, is that a very small percentage, maybe 0.1% of people who watch this stuff or who order the book, or whatever else, they might become clients. And so that would make it worth it for me to do this stuff, right? And then I feel really good knowing that I've helped a lot of other people that maybe couldn't afford to work with me directly or don't want to, or whatever else, right? And so yes, we are doing this partly just to get clients. We want to prove the value before we'd ask you to commit to working with us. Totally transparent. And so we can help more people by getting more information into more hands. And so we can do that by just giving you the book. And then what this is also going to do, right, is there's going to be very few people who actually see this channel, this video, the book. And so if we can give all that to them for free, it'll actually boost the ratings in Amazon a little bit. And then other people might stumble across it on Amazon, and then it can increase that reach, and they might read it and then get some good stuff out of it, right? So just totally transparent. That's why we're doing all this. And so you ordering through Amazon and us reimbursing you means that it's more of an official order, and then we get more credit on Amazon. And if you want to help even more people and get more benefit from yourself, we also have the Ultimate Tax Strategy Bundle, right? Where you could order 10 copies of the book, one for you and 9 to share with friends, family, whatever else you want, or they can all just sit in your basement, I guess. It'd be better if you gave them away. And you're gonna get all this stuff still: audiobook, workshop, my other book, etc. But then we'll also give you, if you haven't done your taxes for 2025, we'll give you a credit towards those. And so like we do taxes here, so you can come get your taxes done with us, and that will be covered up to a certain point. If you got really complicated taxes, we might give you the base for free and still charge you for the complications. But then also a personalized one-on-one tax planning session, right? So for those of you order the book, you read the book, you're like, hey, how do all these strategies apply to me? So one-on-one meeting, you give us some stuff and we'll tell you this is how exactly it applies, and you can just walk away at that point, right? So there's no obligation to do anything else after that, but that is included. So all of that, right? Total value, $1,200+. And all you're gonna do for that is you will buy the copies on Amazon, and we're just not going to reimburse that one. So this one you would order it and we'll reimburse you and send you all the stuff. This one you would order the 10 copies on Amazon and we just wouldn't reimburse you, but you would submit your receipt, and then we would give you all this stuff for free, right? In addition to all this stuff. So $1,200 for only $200. So if you want to help more people, that's a great way to do that as well. So if all that is helpful, again, you can get it totally for free just for you, or you can get it for you and a bunch of friends at an absolute discount. Show me someone else who is a licensed tax expert and retirement planner who's doing taxes for only $200. And that alone is a pretty good deal for 2025. So helps us, helps other people. Should be great. Okay. So yeah, stay tuned for more tax saving strategies for 2026 over the next month or so. Now we're going to jump to Q&A. So let me grab a new sheet of paper in case I need this. Toss that. All right. So what, Ethan, why don't you throw the first question that we got up on the board there? All right, so Bob, yeah, so those are the ones that someone else had emailed in a long time ago, and I never really got around to doing it because we didn't have a good format for it. So Bob wants to know, what's the difference between fee-based and fee-only advisors, or is there a difference? Is that just jargon, or is there an actual difference? And this is a great distinction, Bob, and I think it's really important that everyone knows what this is. So if we think of the two main ways that a financial advisor like me could get paid, the first one is commission, where we sell a product and we get paid some big dollar amount on that. So a common thing would be like annuities, right? A lot of people that work with retirees sell annuities, and so you might get, something like 7 to 10% commission on that amount. So if you got $100,000 that you are investing with someone, or they're going to peel $100,000 out of your total investment, right? And they put some of that into an annuity, they might get a 7% commission on that, which means for selling you that product, they would get $7,000. Right? The other way that advisors can get paid are through fees. And so commissions, right? You buy a product, you don't usually see the money as it's transferring. The insurance or the product producer pays the advisor. With fees, you are paying the advisor directly, and it's going to route through the firm, but ultimately goes to the advisor. And those come in two fashions. One might just be a straight dollar amount, right? Where you're either paying like a flat upfront fee or a monthly fee or a quarterly fee, something like that, for them to do financial planning work for you, etc. Or a percentage fee. Hey, they're going to charge you a percentage of your assets to manage those assets for you. And so that's the other kind. So it's either commissions or fees, right? And so on fees, right, let's say that they were doing the normal like 1% fee for managing it. So they take that same $100,000 and instead of putting in an annuity, they just roll it to an IRA. They charge the 1% on it. They're going to get $1,000 for that first year. And usually that's, divided by 4, and so it'd be like $250 per quarter that they would get paid on that. So $7,000 now versus $250 a quarter. So if an advisor does both of these things, then it's fee based, right? They can do commission and fees because they're fee based. They do a lot of fee work. They manage your investments. Maybe they charge you a planning fee. Hey, we're CFPs. We're fee based. We really emphasize planning. And so they charge you and they tell you about the fees up front. Then they get you in the door, and then for a lot of them, then it's commission later on. So they're not usually leading with commission. I mean, sometimes they are, I guess, but and so that's both. So if you do both, you're fee based. Then there's a separate set of people who just do fees, don't also do the commissions, right? And so that would be, I don't know if it's this way or how you would do that in the Venn diagram, but that would be fee only because they only do fees and they don't do any commissions, right? So fee based means both, fee only means just fees, right? And I don't have any particular issue with commissions in general. I think commissions can be a great way to incentivize great work, great customer service, a lot of different things. My issue with it is mostly in what it incentivizes them to sell, right? In that if you look at this, right, if you got $100,000 that we're going to peel out of your IRA to do something with, right? If I'm getting paid $7,000 now or $250 now, do I have the same incentive to recommend both strategies? And I would say no, right? This I'm not really making a ton, $250, and I'm gonna have to share some of this with the firm, right? And this one I can go to Tahiti with right now. Some people would argue, well, hey, eventually, right, that 1% is going to equal that 7. You're just going to keep making that every year. And I would say the difference is that you only need to work with someone once for them to get paid this, where if you work with them on an ongoing basis, they need to deliver value to you year after year after year for 7 years before they would earn that, right? And so yes, long-term forever, you could get paid more, or you might pay your advisor more doing this, but they got to earn it for the whole time. And they only have to earn this once. But again, more importantly, most of the time on these commissions, and it seems like the worse the product is, the higher the commission, because they need to entice people to sell it, right? So the way you get these bigger 10% commissions is truly terrible products. And that's why, again, we always want, I think everyone should be working right with a fiduciary, which is, hey, they're legally required to act in your best interest. But again, sometimes they can present as a fiduciary because they do fiduciary things with the fee, and then they take that hat off. They got their little, I don't know how to draw a hat. They got their little fiduciary hat, and they take that off, and then they put on their suitability hat, which is, hey, now I just need to sell you something, suitability. Now I just need to sell you something that is suitable for you, that's good for you, not the best. And so oftentimes, between option A and option B, B is way better for you, but A pays them way more. And so they're incentivized to do that. And so that's why I don't care for commissions. Again, not because of the way it's paid, but because of what incentivizes people to do. And personally, in my experience, good financial strategies beat financial products 6 days a week and twice on Sundays. Part of it's just because the number of hands on the cookie jar really matters, right? So if you're just working with a really good financial planner, a really good fee-only fiduciary financial planner at a firm, like you're paying them for all that they know, all the work that they've done to get to that stage, and they can spread that out between you and a bunch of other clients, and probably low-cost investments and some of these other kind of things. And if you're buying products, they got to pay the advisor, they got to pay the insurance company, they got to pay the underwriters, they got to pay the actuaries. There's just a lot more people that need to get paid, so they're more expensive. And the more money you have going out in fees for no value, the worse it is for you. So a lot of the products just end up being bad. There are ways, right, where you can have the same product in an advisory form, which means they're still going to get the 1% on it. They get paid the same way. So I don't have any issue with that. It's not the products. I don't care for annuities, but they do make annuities that get paid the same way either way. Like I could do an annuity if I wanted to, because I get paid the same way either way. But there's a reason most people take the commissionable ones, and it's not because they're better for you. So hopefully that makes sense. Kind of long-winded answer there. Fee-based can do both. Fee only is only going to do the fee-based stuff. I always think you should know what you're paying and what you're getting in exchange for that money. Okay, that's all we have time for today. If you want your questions answered, again, drop those in the comments of the video if you're watching this afterwards. Drop it in the chat if you're watching it live, or you can email us at questions@retirementorship.com. We'd love for you to subscribe, pre-order the book if you want additional tax-saving strategies. Stay tuned for the rest of this month for more things. And if you're looking for someone to do your taxes, again, we do them if you can't find a CPA to do them wherever you're at. So looking forward to seeing you next week, Wednesday, 4 p.m. Central. We'll see you then. Cheers.